Now, we get to a key feature, and that's the idea of operating assets. We want to focus on operating assets and net operating assets because this is really what the company makes money with. The company doesn't make money on financial assets, on investments and market value. That's not really why the company exists. The company exists to make money on what it does to make money. So in this company, for example, we're talking about Intel. Intel makes microchips. Then if we want to analyze Intel, we want to analyze how well they make microchips and how much money they make on microchips versus how much money they make on, say investments in marketable securities, which they just happen to have on their balance sheet. Investments in marketable securities, a lot of companies have that. What makes Intel unique is that they make and sell semiconductors, microchips. And that's what we really want to focus on, is we want to focus on that business. And everything that's non-operating, we want to kind of set aside so we can focus on the operating. So we have the idea of the operating focus. And what research has shown, this is relatively new. What I mean by relatively new, it's like 20 years old. But what research has shown is that this approach is much better predictor of stock value than the DuPont approach. So we want to recognize that corporate value comes from their operations and not through financial assets and liabilities. And your balance sheet and income statement includes some operating items and some non-operating items. And what we want to do is we want to strip away the non-operating items and strictly focus on the operating items. So we already saw that we have return on equity. And return on equity can be broken down into two pieces: operating return and non-operating return. And we can focus on these two things instead of just mixing them all together. So in a traditional DuPont model, we broke return on equity down into profit margin, productivity, and leverage. But again, some debt isn't really borrowed as a financing activity. It's borrowed as an operating activity. Accounts payable and accrued liabilities are not like other kinds of debt. They're really operating debt. And what helps that you understand that is that accounts payable is interest free. A big company that'd be an example of this is Walmart, which has huge accounts payable, but it doesn't have to pay any interest on it. So that's different from accounts payable that's interest free, is different from a bond payable where you have to pay interest on it. And these are really part of the company itself. So what we're going to do is we're going to break out our assets according to operating and non-operating. We're going to do the same thing with liabilities. We're going to break them out into operating and non-operating. And we're going to recompute return on assets, really return on equity, focusing strictly on the operating numbers. So we're going to take, instead of taking income divided by average equity, we're going to take operating profit divided by net operating assets, which would be operating assets minus operating liabilities. In other words, the portion of equity that's operating as opposed to the portion that is non-operating. So we're going to take a net operating profit after tax would ignore all the non-operating items also. So what this is a shift from the formula of return on equity towards a measure that strictly focuses on operations. And what I did was I did some, believe it or not, some of these notes actually come from me. So the way you would calculate these numbers, and this is very important, is you would take net operating profit before taxes. That would include only the operating items. You would subtract the taxes on those operating items. You have to break down taxes because some taxes may apply to non-operating items. And then you would get a figure called NOPAT, net operating profit after taxes. And that's in your numerator right here, NOPAT. Net operating profit after taxes. And that's only the operating part of the income statement. For assets, we're going to go through our assets and we're going to take only the operating assets and we're going to set aside the non-operating assets. Same thing for liabilities. We're going to split our liabilities into operating versus non-operating. And then equity is going to be a product of net operating assets minus net operating liabilities. So just like this minus this equals this, similarly, this minus this equals this. So how do we do this? Well, here's a balance sheet. And you can see all the operating items here are shown in red. Accounts receivable, inventory, prepaid expenses, deferred tax assets, other current assets. These are things that are directly related to operations. The items in black are not related to operations. PP&E is used to make things, capitalized lease expenses, natural resources, equity method investments, goodwill even. Goodwill is invested in assets and companies that make money. Similarly for liabilities, accounts payable, accrued liabilities, unearned revenues, deferred income tax liabilities. In fact, deferred income taxes can really be both, but what we do is we keep deferred as operating, even though a portion of it could be financing. Pension is operating, and again, all deferred tax items are going to be operating, not non-operating, and that's an important thing to pay attention to. Financing is going to be everything else. If you look at these financing items, these are items that are kind of generic, because these are things that every company could have, and it's not really unique to any one industry. A capitalized lease obligation is money that you owe to the bank for a lease. That's all. The same thing for long-term liabilities. Bonds and notes payable, I should say. Now, discontinued operations are non-operating because they're not going to go forward into the future. So here would be a breakdown of Intel's balance sheet according to operating and non-operating. And what you would want to do is you'd add up the red items separately from the black items. And you would put them all in here. So your operating assets would be added up here. Your operating liabilities would be added up here. And your net operating assets would be the difference, because net is assets minus liabilities. So again, the balance sheet needs to be broken down. It's nice to do this on a spreadsheet where you can actually make two more columns, one for operating, one for non-operating, and then show that they all balance later on.